Hello everyone, welcome to the Capital Intelligence channel. Today, we're bringing you an explainer that cuts straight to the core of what serious investors actually need to know to survive and, more importantly, build long-term wealth. We're going to look at the definitive data on how modern financial markets truly operate. No fluff, just the most essential information for people who are serious about finance.
So let's dive right into this big question because it's absolutely crucial. It fundamentally shifts how you have to view market dynamics. For decades, the financial industry has just assumed that markets are like this rigid physics equation, perfectly rational, perfectly calculable. But today, we are leaving that rigid math in the past. We're stepping into the living, breathing reality of modern trading. In this explainer, we'll be covering 6 key areas. First, markets as biological ecosystems. Second, the active management illusion. Third, the market timing trap. Fourth, overcoming your investing biases. Fifth, the high-frequency trading reality. And finally, adapting to survive and thrive. Let's get right to it.
Part 1. Markets as biological ecosystems. All right, so like we just mentioned, for decades, the old efficient markets hypothesis treated the market like a physics equation, full of totally rational actors, basically like inanimate objects. But MIT professor Andrew Lowe's adaptive markets hypothesis reveals a massive paradigm shift. It turns out markets behave way more like biological ecosystems. They're driven by fierce competition, intense human emotion, and constant, non-stop evolution.
So what does that actually mean? Well, in this market ecology, we don't have perfect calculating machines. Instead, we have distinct species of market participants. Think retail investors, pension funds, quantitative hedge funds. And here's the kicker. Each of these species acts in its own self-interest, they make completely irrational behavioral mistakes, and they are forced to continuously adapt their strategies just to survive as the environment changes around them. It's literally survival of the fittest.
Moving on to part 2, the active management illusion. Now, let's talk about the species of active fund managers. How are they doing in this highly competitive environment? Well, according to the incredibly highly respected 2025 SPIVA scorecard, which actually accounts for survivorship bias, a staggering 79% of active large-cap equity managers trailed the S&P 500 benchmark. Let that sink in. Nearly 8 out of 10 highly educated, massively resourced professionals failed to beat a basic passive index. No way, right? But the data doesn't lie. And honestly, the math gets aggressively worse over time. Just look at how the probability of picking a winning active manager shrinks drastically as your time horizon expands. Over a 20-year period, your chance of finding a manager who actually beats the market plummets to a dismal 5 to 7%. It's a severe statistical trap. Basically, the longer you play, the worse your odds get. Which brings us to part 3, the market timing trap. Okay, so active stock picking fails. But what about trying to time the market? Jumping in and out to avoid the worst days. Well, here's one of the most vital pieces of information a serious investor can internalize. Missing just the 10 best days over a 30-year period effectively halves your total historical gains. Literally cuts it in half. And if you try to get cute and accidentally miss the 60 best days, your multi-decade return actually turns negative. Poof, gone. Let's make this hyper-specific and look at the year 2025. If you had simply stayed fully invested that year, you would have captured a near 18% gain. Not bad. But if you had pulled your money out of fear and happened to miss just the 4 absolute best trading days of that entire year, your 17.88% gain would have completely collapsed into a net loss. You'd actually be down almost 0.5% over just 4 missed days. So why does this happen? Why is market timing virtually impossible? It's all because of a statistical phenomenon called volatility clustering. Simply put, the market's absolute best days almost always happen right next to its absolute worst days, usually during periods of high panic. It's kind of like rain and rainbows. If you try to dodge the thunderstorm by pulling your money out, you inevitably miss the rainbow that immediately follows. All right, part 4, overcoming your investing biases. If the data clearly proves that market timing destroys wealth, why do so many of us still try to do it? Why do we consistently buy high and sell low? Well, the answer lies entirely in our primate brains. We are hardwired with emotional responses that served our ancestors incredibly well for survival in the wild, sure, but for managing a modern financial portfolio, they are an absolute disaster.
As investors, we're constantly torn between two immense psychological forces. On one side, you have FOMO, the fear of missing out. This drives us to buy at the absolute top when everyone else is bragging about their gains. Think about recent speculative bubbles, right? On the other side, there's loss aversion. This forces us to panic sell at the exact bottom. Why? Because behavioral finance proves that the psychological pain of losing a dollar is literally twice as severe as the joy of gaining one. We are fighting our own biology here. So to survive this market ecology, you absolutely have to learn to override these deep-seated emotional biases. As the Dow Bar studies consistently show, the average investor vastly underperforms the market for one simple reason. They let short-term fear and greed completely disrupt their long-term discipline. Emotional decision-making is, without a doubt, your portfolio's worst enemy.
Next up, Part 5, the high-frequency trading reality. Overriding your emotions is especially critical today because, frankly, you are sharing the market ecosystem with some newly evolved apex predators. Enter high-frequency trading, or HFT. These powerful computer algorithms process vast amounts of data and execute complex trades in mere microseconds. This is evolution operating at the absolute speed of thought, and it has fundamentally altered the microstructure of the whole market ecology. Now, these algorithms have a real dual nature to them. On one hand, proponents will tell you that HFTs provide massive daily liquidity and narrow bid-ask spreads, making normal trades faster. But on the other hand, critics point out that during times of market stress, this liquidity can just instantly vanish, which ends up amplifying systemic risk and exacerbating brutal flash crashes. It's a real double-edged sword. What you really need to take away from this is that everyday retail investors face a massive structural disadvantage. We simply lack the physical infrastructure, like exchange colocation and ultra-low latency microwave networks, to compete at these microsecond speeds. Attempting to actively day trade against these HFTs, it's a losing battle. You're dealing with severe information asymmetry and latency arbitrage. Long story short, you cannot outtrade a machine. Finally, let's wrap up with Part 6, Adapting to Survive and Thrive. So, how does a serious investor actually survive and thrive in an ecology filled with apex predators, behavioral traps, and efficient pricing? The empirically backed solution is actually pretty elegant in its simplicity. First, abandon the illusion of active management. Second, recognize that market timing is statistically impossible. Third, override your biological FOMO and loss aversion. Fourth, accept that you can't outtrade high-frequency algorithms. The real answer? Invest passively, broadly, and for the long term. Capture the market's overall return efficiently through low-cost index funds, and stay fully invested through the volatility so you never miss those critical best days. We'll leave you with this final, provocative question. If the market is an evolutionary ecosystem, is your current strategy evolving or is it going extinct? In a financial world driven by constant adaptation, clinging to outdated tactics like market timing, stock picking, and emotional trading guarantees you are going to be left behind by the math. So, adapt your strategy, lower your costs, and let the market's long-term evolution do the heavy lifting for you. Thank you so much for joining us on this explainer, and we will catch you next time.